Hello and welcome. If the D775 OA exam has been on your mind and you're wondering how to approach it, then you're in the right place. Our website has D775 OA questions and answers, and it won't cost you a thing. OA exams are tough, so everything from guides to practice questions is free. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. In this video, we will cover questions from financial ratio analysis, time value of money, capital budgeting, cost of capital, financial markets. So, let's get started.
Question 1. A small manufacturing company hires 2 new finance team members. One spends days reconciling general ledger entries and preparing the annual tax return, while the other builds 3-year cash flow projections and evaluates whether to fund a new production line. Which statement best describes the difference between these two roles? Your options are A. Both roles focus on past transactions, but only the second uses spreadsheets. B. The first role plans for the future, while the second records what already happened. C. The first role focuses on accounting, which records past transactions, while the second role focuses on finance, which manages resources for future decisions. D. Accounting and finance are interchangeable terms for the same record-keeping work. Which one is it? Pause the video if you need more time. The correct answer is C. The first role focuses on accounting, which records past transactions, while the second role focuses on finance, which manages resources for future decisions. C is correct because accounting records and reports past financial transactions for compliance and accuracy, while finance manages resources to plan for the future and support growth. Tax returns and ledger reconciliation are accounting tasks, while cash flow projections and investment evaluation are finance tasks. A is wrong because finance is fundamentally forward-looking and does not focus on past transactions. The distinction is not about software tools but about time orientation and purpose. B is wrong because the roles are reversed. The person reconciling ledgers and filing tax returns is doing accounting, which deals with historical data, not future planning. D is wrong because accounting and finance are distinct disciplines with different objectives. Accounting prioritizes compliance and accuracy, while finance prioritizes resource optimization and growth. Accounting and finance are 2 distinct disciplines that are often confused for the same thing. Understanding what separates them comes down to one key idea: time orientation. Accounting records and reports transactions that have already occurred, producing statements that outside parties can trust. Finance uses those same statements as a starting point, then looks ahead. Forecasting, allocating capital, and evaluating which projects deserve funding. The accounting team produces precise, audited outputs, the balance sheet, income statement, and cash flow statement. Finance professionals then take those outputs and build forecasts, evaluate the cost of capital, and construct long-range models. On an exam, watch for the verb. If a scenario describes recording, reconciling, or auditing, that is accounting. If it describes planning, forecasting, or deciding among future options, that is finance. The time orientation is the single best signal. Together, these 2 disciplines form one larger system. Accounting gives the firm a reliable history to trust. Finance uses that history alongside forecasts and strategic judgment to steer the firm forward. Question 2. A controller and a CFO are preparing materials for a board meeting. The controller assembles the audited balance sheet and income statement from the prior fiscal year. The CFO presents a 5-year capital investment plan and the financing strategy to fund it. Which statement correctly describes the time orientation of their work? Your options are the controller's work looks backward at historical data, while the CFO's work looks forward at future strategies and plans. B. Both presentations rely entirely on forecasts of future cash flows. C. The controller predicts next year's revenue while the CFO reviews last year's results. D. Time orientation is irrelevant since both roles use the same financial statements. Take a second. Which answer would you pick? The correct answer is A. The controller's work looks backward at historical data, while the CFO's work looks forward at future strategies and plans. A is correct because accounting work looks at historical data such as audited statements, while finance work looks at the future through strategies and financial plans. The controller represents accounting and the CFO represents finance in this scenario. B is wrong because the controller's audited financial statements report what already happened during the prior fiscal year. Forecasting future cash flows belongs to finance, not accounting. C is wrong because the roles are reversed. The CFO does the forecasting and the controller reviews historical results in this scenario. D is wrong because time orientation is the defining distinction between the two disciplines, with accounting backward-looking and finance forward-looking. The single clearest dividing line between accounting and finance is time orientation, specifically whether the work looks backward at what already happened or forward at what has not yet occurred. Accounting is anchored to completed transactions recorded in source documents like invoices and bank statements. Finance is built from assumptions about what might happen, even when those assumptions are informed by historical patterns. Accounting artifacts, the balance sheet, income statement, and cash flow statement are all records of a period that has already closed, prepared after the fact and reviewed for accuracy. Finance artifacts, capital plans, pro formas, and DCF models are structured guesses about the future, reviewed for reasonableness rather than precision. To grapple with uncertainty, finance relies on tools like discounted cash flow analysis, scenario modeling, and capital budgeting frameworks, none of which can be built from completed transactions alone. Time orientation is not about seniority or complexity. The discipline is determined by the nature of the artifact. If it is built from completed transactions, it is accounting work. If it is built from assumptions about the future, it is finance work. Question 3. A multinational corporation needs to ensure its quarterly financial reports comply with the rules that govern public company disclosures in the United States. Which framework primarily guides this reporting obligation? Your options are A. Risk-return trade-off principles set by individual investors. B. International financial reporting standards applied only in Europe. C. Diversification rules established by the company's board. D. Generally accepted accounting principles known as GAAP. Before I reveal it, which one do you think is right? The correct answer is D. Generally accepted accounting principles known as GAAP. D is correct because GAAP is the accounting framework that governs financial reporting in the United States, ensuring accuracy, transparency, and compliance with regulators. Public companies in the U.S. must follow GAAP when preparing financial statements. A is wrong because risk-return trade-off is a finance principle for evaluating investments, not a regulatory framework for reporting. It does not govern statutory disclosure. B is wrong because IFRS is a global accounting standard, not exclusive to Europe and US. Public companies primarily report under GAAP rather than IFRS. C is wrong because diversification is an investment strategy concept, not an accounting reporting standard. A board does not establish disclosure rules, regulators do. GAAP, generally accepted accounting principles, is the foundational framework governing how U.S. companies record transactions, value assets, and present financial statements. It exists to ensure that every public company speaks the same financial language. GAAP covers 4 core areas: recording transactions, valuing assets and liabilities, recognizing revenue and expenses, and presenting the resulting picture in financial statements. Without a shared standard, statements from different companies would be impossible to compare or trust. The international counterpart is IFRS, International Financial Reporting Standards, used across the EU, much of Asia, and Latin America. While the two frameworks share most underlying principles, they differ in areas like inventory valuation and revenue recognition, AUIs. Company issuing securities abroad may need statements under both. GAAP is maintained by the Financial Accounting Standards Board, or FASB. Two foundational ideas it enforces are the matching principle, expenses recognized in the same period as related revenues, and the historical cost principle, which records assets at their original purchase price rather than fluctuating market value. GAAP is a reporting framework, not a finance principle or investment strategy. It tells companies how to record and communicate what has already happened, so that investors, lenders, and regulators can all read from the same page. Question 4. A young couple meets with a financial planner to budget their household income, save for retirement, and choose insurance coverage. Which type of finance does this scenario best illustrate? Your options are A. Public finance, because households contribute taxes that fund government services. B. Personal finance, because the focus is managing income, savings, and expenses for an individual or family. C. Business finance, because the planner is paid for the service. D. Corporate finance, because life insurance is sold by a company. What's your answer? Commit to one before I continue. The correct answer is B. Personal finance, because the focus is managing income, savings, and expenses for an individual or family. B is correct because personal finance focuses on managing income, savings, investments, debt, and expenses for individuals and families. Budgeting, retirement saving, and insurance choices are core personal finance activities. A is wrong because public finance manages government budgets, taxes, and public spending, not household budgeting for a private family. C is wrong because business finance manages company money for raising capital and investing in projects, which is not what this couple is doing. D is wrong because the fact that an insurance product comes from a company does not make the buyer's planning corporate finance. The activity centers on personal goals. Personal finance is the branch of finance focused on managing money at the level of one person or one household. It covers far more than just budgeting. It includes every financial decision a family makes across their lifetime. Mechanically, personal finance rests on 6 building blocks: budgeting, saving, investing, insurance, debt management, and retirement planning. Each addresses a different dimension of a household's financial life, and together they form a complete system for making trade-offs with scarce resources. Think of a household as the hub of a wheel. Every spoke, budgeting, saving, investing, insurance, debt, and retirement, connects back to that central goal of building and protecting the family's net worth over time. Personal finance, business finance, and public finance share many of the same tools, but the category is determined by who the money belongs to and who benefits. Personal finance serves one family, business finance serves a company's shareholders, and public finance serves citizens through government budgets. The key takeaway is that personal finance is broader than budgeting alone. Any financial decision made by an individual or household, whether it involves income, spending, saving, investing, borrowing, or insuring, falls squarely within personal finance. Question 5. A state agency reviews how much revenue it will collect from gasoline taxes next year and decides how much of that revenue to allocate to highway maintenance versus rural broadband expansion. Which type of finance is the agency practicing? Your options are A. Public finance, because the work involves managing government budgets, taxes, and spending priorities. B. Personal finance, because individual taxpayers fund the gasoline tax. C. Business finance, because the agency operates with revenue and expenses. D. Behavioral finance, because the agency weighs political preferences. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Public finance, because the work involves managing government budgets, taxes, and spending priorities. A is correct because public finance manages government budgets, taxes, spending priorities, and public debt. Allocating tax revenue to infrastructure programs is a textbook public finance activity. B is wrong because personal finance covers individuals and families managing their own money, not how a government allocates collected tax revenue. C is wrong because business finance focuses on private company decisions about raising capital and investing for shareholder value, not government resource allocation. D is wrong because behavioral finance studies how psychological factors affect financial decisions in markets and is not a category alongside personal, public, and business finance in this framework. Public finance is the branch of finance focused on how governments raise and allocate collective resources. It exists because modern societies depend on goods and services that markets alone cannot reliably provide. Things like national defense, courts, and public roads. Mechanically, public finance has three core moving parts: revenue collected through taxes, spending directed toward programs like defense and education, and debt issued when current revenue falls short of desired spending. Each piece is shaped by political choices, legal rules, and economic conditions. Revenue flows in through taxation. Spending flows out toward public priorities. And when there is a gap, governments issue bonds. Balancing these three elements over time, staying solvent while meeting public needs, is the central challenge of public finance. A common exam trap is confusing the actors. The category attaches to the entity making the financial decision, not to the source of the money. A household paying taxes is doing personal finance. The government agency deciding how to spend those taxes is doing public finance. Public finance, business finance, and personal finance use overlapping tools: budgets, forecasts, debt instruments, but answer different questions. Public finance asks what government should do with collective resources. The label always flows from who owns the money and who benefits from the decisions. Question 6. A newly appointed financial manager at a mid-sized software company is meeting with the CEO. Which combination of responsibilities best describes the manager's core job? Your options are A. Recording journal entries, posting to the general ledger, and preparing the trial balance. B. Auditing financial statements for outside investors and certifying GAAP compliance. C. Choosing which projects to pursue, deciding how to pay for them, and tracking whether they succeeded. D. Designing the user interface and setting promotional pricing for the product. Which would you go with? Lock it in before the reveal. The correct answer is C. Choosing which projects to pursue, deciding how to pay for them, and tracking whether they succeeded. C is correct because a financial manager picks which projects to pursue, decides how to pay for them through debt or equity, and tracks results to evaluate success. These three responsibilities form the core of corporate finance leadership. A is wrong because recording journal entries and posting to the ledger are accounting tasks performed by bookkeepers or controllers, not by a financial manager driving investment decisions. B is wrong because external auditing is conducted by independent audit firms, not internal financial managers. GAAP certification is a compliance function rather than a strategic finance role. D is wrong because user interface design and promotional pricing are product and marketing decisions, not finance manager responsibilities. The financial manager is the person responsible for steering a company's financial decisions. Regardless of the exact title, the underlying job is the same, and it's built around 3 core responsibilities. Every financial manager works along 3 tracks: deciding which projects to pursue through investment analysis, choosing how to fund those projects through financing decisions, and monitoring actual results against forecasts through performance tracking. The financial manager sits at the intersection of strategy, accounting, and capital markets. Unlike the accounting team, the financial manager uses historical records as raw material to build forward-looking models and recommend decisions, not to record transactions or certify compliance. A common exam trap is confusing the financial manager with the controller or external auditor. The controller focuses on accurate record keeping. The auditor verifies that statements comply with accounting standards. Neither role is about choosing investments or funding. That belongs to the financial manager. The financial manager picks the projects, picks the funding, and watches the outcomes. That triad, investment, financing, and tracking, is what separates the financial manager from every other role in the organization. Question 7. A retail chain is deciding whether to spend $10 million now to open 30 new stores, with expected payback occurring over the next 7 years. Which finance concept most directly guides this decision? Your options are: A. Bond rating analysis, since the project involves long-term cash flows. B. Time value of money, because $1 today is worth more than $1 in the future, and projects must be evaluated against that gap. C. Inventory turnover ratios for the new store's first quarter. D. Profit margin benchmarking against industry peers. Don't overthink it. Which one feels right? The correct answer is B. Time value of money, because $1 today is worth more than $1 in the future, and projects must be evaluated against that gap. B is correct because time value of money is the principle that money available now is worth more than the same amount in the future, and it underpins investment decisions about projects with future cash flows. The retail chain needs to discount future paybacks to present value to determine if the $10 million investment is worthwhile. A is wrong because bond rating analysis applies to debt securities issued by companies or governments, not to internal capital budgeting decisions about opening stores. C is wrong because inventory turnover measures operational efficiency once stores are open and would not drive the initial investment decision. D is wrong because profit margin benchmarking is useful for ongoing performance review, but does not evaluate whether to fund a multi-year capital project. The time value of money is one of the most fundamental principles in all of finance. At its core, it says that $1 in your hand today is worth more than $1 promised to you in the future. $1 received today has 3 concrete advantages. It can be invested right now to earn a return. It protects you against inflation eroding its value. And unlike a future promise, it carries no uncertainty about whether it will ever actually arrive. Time value is applied mechanically through 2 operations that are mirror images of each other. Discounting converts a future cash flow into its present equivalent by dividing through a discount rate. Compounding projects a present amount forward by multiplying through an interest rate. Net present value ties these operations together. A manager projects future cash flows, discounts each one back to today using the cost of capital, sums them, and subtracts the initial investment. Upon positive NPV means the project creates value, and negative NPV means it destroys value. Time value isn't just one specific formula. It's the guiding concept behind capital budgeting, bond pricing, mortgages, and more. Whenever a decision involves cash flows at different points in time, this principle is always working in the background. Question 8. A growing technology firm needs to raise capital for an acquisition. The CFO must choose between issuing new bonds, which carry interest payments but no ownership dilution, and selling new shares of stock, which give up ownership but require no required payments. Which finance concept best describes this decision? Your options are A. Liquidity management because cash will be needed at closing. B. Inventory financing because the target firm holds physical inventory. C. Income statement classification because the choice affects revenue lines. D. Capital structure and the cost of capital, which weighs the trade-off between debt and equity to control risk. Got a guess? Lock it in. The correct answer is D. Capital structure and the cost of capital, which weighs the trade-off between debt and equity to control risk. D is correct because the choice between debt and equity is a capital structure decision, and the cost of capital is the framework used to compare the two. Debt is cheaper but adds bankruptcy risk, while equity dilutes ownership but reduces required payments. A is wrong because liquidity management deals with meeting short-term obligations, not with the long-term mix of debt and equity used to fund an acquisition. B is wrong because inventory financing is a short-term working capital tactic and does not describe the strategic choice between bonds and stock issuance. C is wrong because income statement classification is an accounting reporting concern and does not capture the strategic trade-off between debt and equity. Capital structure is the mix of debt and equity a firm uses to finance itself. The cost of capital is the blended price the firm pays for that mix. These two concepts are inseparable. The financing mix directly determines how much money costs. Firms can borrow through debt, paying predictable interest that is tax deductible, or raise equity by selling shares, which demands a higher expected return because shareholders bear residual risk. Neither extreme is optimal. The right structure balances the cost advantages of debt against the danger of taking on too much. Mechanically, the weighted average cost of capital in CSRD or WACC blends these two costs. The after-tax cost of debt is lower because interest is tax deductible. The cost of equity is higher because shareholders face more risk. Each is weighted by its share of total capital, and the sum is the firm's blended cost of money. Too little debt means the firm forgoes the tax shield and cheap borrowing. Too much debt raises bankruptcy risk, pushing up the cost of both debt and equity. The optimal structure sits in between, minimizing WACC while keeping risk within acceptable limits. Capital structure is ultimately a balancing act. The goal is the mix that minimizes the weighted average cost of capital without making the firm fragile under stress, a judgment that depends on the firm's industry, cash flows, and risk tolerance. Question 9. A company's quarterly report shows assets of $5.1 million, liabilities of $2 million, and equity of $3.1 million. Which financial statement does the snapshot represent? Your options are A. The balance sheet, which shows assets, liabilities, and equity at a single point in time. B. The income statement, which shows revenue and expenses over a period. C. The cash flow statement, which reconciles operating, investing, and financing activities. D. The statement of retained earnings, which tracks dividends declared. Which one is it? Pause the video if you need more time. The correct answer is A. the balance sheet which shows assets, liabilities, and equity at a single point in time. A is correct because the balance sheet is a snapshot of assets, liabilities, and equity at a single point in time. The accounting equation assets equal liabilities plus equity holds in this scenario, which signals a balance sheet view. B is wrong because the income statement shows revenues, expenses, and net income over a period such as a quarter, not a snapshot of what the firm owns and owes. C is wrong because the cash flow statement reports cash movement across operating, investing, and financing categories rather than the position of assets and liabilities. D is wrong because the statement of retained earnings traces changes in retained earnings, not the full position of assets, liabilities, and equity. The balance sheet is one of 3 core financial statements every business produces. Unlike the income statement or cash flow statement, it captures the firm's financial position at a single point in time, a snapshot, not a story over a period. The balance sheet answers 3 fundamental questions: what the firm owns, recorded as assets; what the firm owes, recorded as liabilities; and what remains for the owners, recorded as equity. These 3 elements are linked by the accounting equation. Assets equal liabilities plus equity, and that equation must hold on every properly prepared balance sheet. Mechanically, assets occupy one side, organized from most liquid to least, starting with cash and working down through receivables, inventory, and long-term assets. On the other side, liabilities are ordered by when they come due, followed by equity, which captures retained earnings and paid-in capital. Every dollar of assets was funded by either a liability or an equity source, so the 2 sides always balance. The classic exam trap is confusing the balance sheet with the income statement. The balance sheet shows the firm's position on a specific date, the last day of a quarter or fiscal year. The income statement shows performance over a period, summing revenues and expenses across months. If a question references holdings or obligations at a particular date, that is the balance sheet. Together, the balance sheet, income statement, and cash flow statement give a complete picture. The balance sheet is the snapshot. The income statement explains how earnings flowed. The cash flow statement reconciles the change in cash. Keep those 3 roles clear and you will rarely confuse them under exam pressure. Question 10. A small bakery owner wants to know how much profit her shop earned during the past 12 months, including revenue from coffee sales, food cost of goods sold, and the salary of 1 assistant. Which financial statement should she review? Your options are: A. The balance sheet showing the equipment, cash and loan balances at year end. B. The statement of shareholders' equity tracking ownership changes. C. The income statement which reports revenue, expenses, and net income over a period of time. D. The bank reconciliation form showing daily cash counts. Take a second. Which answer would you pick? The correct answer is C. The income statement which reports revenue, expenses, and net income over a period of time. C is correct because the income statement reports financial performance over a period, showing revenue, expenses, and net income. 12 months of revenue, food costs, and wages would all appear here to produce the annual profit figure. A is wrong because the balance sheet shows position at a single point in time and would not directly report 12 months of revenue or expenses. B is wrong because the statement of shareholders' equity tracks changes in ownership accounts and does not break down revenue or expenses. D is wrong because a bank reconciliation matches the bank statement to the books and does not measure profit or revenue over a period. The income statement reports a firm's financial performance over a period of time, typically a quarter or fiscal year, unlike the balance sheet, which captures a single snapshot, The income statement tells the story of how revenue turned into profit across an entire operating cycle. The statement begins with revenue at the top. Subtracting cost of goods sold gives gross profit, what remains after direct production costs. Deducting operating expenses like wages, rent, and depreciation yields operating income. Finally, interest and taxes are subtracted to arrive at net income, the profit available to shareholders. Each line on the income statement tells a different part of the performance story. Strong gross profit, but weak operating income signals too much overhead. Strong operating income but weak net income may mean the firm is heavily leveraged. Ratios like profit margin and return on equity all draw from these numbers. The critical exam trap is confusing the income statement with the cash flow statement. The income statement is built on accrual accounting. WGU D775 revenue and expenses are recorded when earned or incurred, regardless of when cash changes hands. A firm can report strong net income while simultaneously burning through cash if customers pay slowly or inventory builds up. Finally, remember that the income statement and balance sheet are connected. Net income earned during the period flows into retained earnings, which appears in equity on the balance sheet. Understanding that link helps you see the three core financial statements as one integrated system rather than three separate reports. Question 11. An investor reviews two securities offered by the same publicly traded retailer. One gives a vote at annual shareholder meetings and pays a dividend that fluctuates with company performance. The other pays a fixed dividend each quarter but gives no voting rights. Which statement best identifies these two securities? Your options are: A. Both are types of bonds. The first is a corporate bond and the second is a treasury bond. B. The first is common stock and the second is preferred stock. C. The first is a derivative and the second is a futures contract. D. Both are mutual funds offered by the same fund family. Before I reveal it, which one do you think is right? The correct answer is B. The first is common stock and the second is preferred stock. B is correct because common stock provides voting rights and a dividend that depends on company performance, while preferred stock pays a fixed dividend but typically carries no voting rights. The two securities described match these definitions exactly. A is wrong because bonds represent debt, not ownership, and bondholders receive interest payments rather than dividends. Treasury bonds are issued by the U.S. government, not by a retailer. C is wrong because derivatives draw their value from another asset and would not pay dividends directly to holders in the way described. D is wrong because mutual funds are pooled investments, not individual securities issued by a single retailer, and shares in them do not provide voting rights at a company shareholder meeting. Corporations issue two distinct forms of equity, common stock and preferred stock. Though both represent ownership in the same company, they serve very different investor needs and come with very different rights and risks. Common stock gives shareholders voting rights, variable dividends that rise and fall with company performance, and last claim on assets in liquidation. Preferred stock flips each of those features: no voting, a fixed dividend, and a higher priority claim if the firm is wound down. Preferred stock sits between debt and common stock in the capital structure. Bondholders are paid first, then preferred shareholders, and common shareholders receive whatever remains. This ordering explains why common shareholders bear the most risk, but also capture the most upside when the firm succeeds. The choice between common and preferred stock is fundamentally about trading participation against certainty. Common stock offers a vote and a share in corporate growth. Preferred stock offers predictable income and a stronger safety net, at the cost of voting rights and limited upside. When a scenario describes voting rights and dividends that vary with performance, that points to common stock. Fixed dividends, no voting, and higher liquidation priority all point to preferred stock. Not all equity is the same. Question 12. A first-time investor wants ownership in a publicly traded automaker and the right to vote on board members and major corporate actions. Which security best matches the goal? Your options are A. Treasury bond issued by the federal government. B. Municipal bond issued by a city government. C. Preferred stock in the automaker. D. Common stock in the automaker. What's your answer? Commit to one before I continue. The correct answer is D. Common stock in the automaker. D is correct because common stock comes with voting rights at shareholder meetings and ownership in the issuing company. An investor who wants to vote on board members must hold common stock rather than preferred stock or bonds. A is wrong because treasury bonds are debt instruments and provide no ownership or voting rights in any company. They pay interest rather than represent equity. B is wrong because municipal bonds are loans to local governments for projects like roads and schools, with no ownership stake in any corporation. C is wrong because preferred stock typically does not include voting rights. It offers a fixed dividend and priority claim in liquidation, but does not let holders vote at shareholder meetings. Voting rights are the defining feature that separates common stock from every other security a company can issue. Understanding why shareholders vote ACE and who does not is the key insight behind this concept. Common shareholders are the only category that routinely votes. Preferred shareholders trade away their vote in exchange for priority dividends and liquidation preference. Bondholders are creditors. They hold a contract, not an ownership stake, so they have no governance voice whatsoever. The vote is the structural mechanism connecting ownership to control. Shareholders elect the board. The board hires the CEO, and major actions like mergers or charter amendments require direct shareholder approval. One share, one vote is the standard model in most public companies. Each year, shareholders receive a proxy statement listing items up for vote. These typically include electing directors, ratifying the independent auditor, advisory votes on executive compensation, and any major corporate actions or shareholder proposals on the ballot. When an exam scenario describes an investor who wants ownership and governance influence, the answer is common stock, every time. Preferred stock and bonds lack routine voting rights, making the vote the clearest indicator that a security represents true ownership. Question 13. An employee receives a stock grant in her employer that pays a small dividend, fluctuates in value as the company's earnings move, and entitles her to vote on shareholder proposals. Which type of equity does she hold? Your options are A. Common stock, which provides ownership, voting rights, and dividends tied to company performance. B. Preferred stock with a guaranteed fixed dividend. C. A corporate bond that matures in 10 years. D. An options contract that expires at year end. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Common stock, which provides ownership, voting rights, and dividends tied to company performance. A is correct because common stock represents ownership and gives shareholders the right to vote and to receive dividends that depend on company performance. The features described match common stock exactly. B is wrong because preferred stock pays a fixed dividend rather than a variable one and does not generally carry voting rights at shareholder meetings. C is wrong because a corporate bond is debt rather than equity. Bondholders receive interest, not dividends, and have no ownership or voting rights. D is wrong because an options contract gives the right to buy or sell at a set price and does not represent ownership or pay dividends. Common stock is the standard form of equity ownership in a corporation, the instrument most employees and investors encounter first. Understanding its core features helps you recognize it in any scenario. Every common share grants 3 fundamental rights: the right to vote on shareholder matters, the right to receive dividends when the board declares them, and a residual claim on company assets. These rights are identical for every share within a class, which keeps governance clean and trading simple. Mechanically, the share price moves with the company's earnings and market sentiment. Dividends fluctuate with profits. Some companies pay them regularly, others reinvest all earnings for growth. Both approaches are legitimate ways to deliver value to shareholders. The key exam distinction is between common and preferred stock. Common stock features a variable dividend and voting rights. Preferred stock features a fixed dividend and typically no voting rights. When a scenario combines variable dividends with shareholder votes, that points to common stock every time. Remember, common stock is the default ownership instrument in any corporation. Whenever you see variable dividends paired with voting rights, especially in employee equity programs, common stock is the right answer. Question 14. A retiree wants a security that pays a steady, predictable dividend each quarter and ranks above common stock in claims if the company is liquidated. She is willing to give up voting rights in exchange for that predictability. Which security best matches her preferences? Your options are A junk bond rated BB by major rating agencies. B, common stock in a fast-growing technology firm. C, preferred stock, which acts like a hybrid of stock and bond with fixed dividends and a higher claim than common stock. D, a futures contract on a commodity such as wheat. Which would you go with? Lock it in before the reveal. The correct answer is C, preferred stock, which acts like a hybrid of stock and bond with fixed dividends and a higher claim than common stock. C is correct because preferred stock is a hybrid security that pays fixed dividends, ranks above common stock in liquidation claims, and typically carries no voting rights. The retiree's profile maps directly to the security. Is wrong because a junk bond is high risk, high reward debt and is not characterized by predictability. The retiree wants stability rather than speculative debt exposure. B is wrong because common stock dividends move with company performance and are not predictable. Voting rights do not match the trade-off the retiree is making. D is wrong because a futures contract is a derivative used for hedging or speculation, not a steady income security for a retiree seeking predictable payments. Preferred stock occupies a unique position in a company's capital structure, blending features of both equity and debt. Understanding what makes it a hybrid helps explain why it exists and who finds it useful. On the equity side, preferred shareholders are owners of the firm. On the debt side, they receive a fixed dividend and have a higher claim on assets than common shareholders if the company is liquidated. This combination, ownership with priority and predictability, is the defining characteristic of preferred stock. In the capital structure, bondholders sit at the top with a contractual claim. Preferred shareholders rank below bondholders but above common shareholders. This ordering matters most in liquidation, and it is also the order in which dividends must be paid. 3 features define preferred stock. A fixed dividend paid before common shareholders receive anything, a higher liquidation claim than common stock, and typically no voting rights at shareholder meetings. Preferred holders trade governance influence for income stability. The most important distinction to remember is that preferred stock is equity, not debt. Missing a preferred dividend does not trigger bankruptcy the way missing a bond payment does. Preferred stock is for investors who want predictable income and ownership status without the full risk of common stock or the contractual obligations of bonds. Question 15. A robotics startup wants to raise a large amount of capital and is willing to comply with strict regulation, accept public scrutiny, and trade ownership stakes on a major exchange. Which equity raising path matches this scenario? Your options are A. Issuing a treasury bond through a federal auction. B. A public equity offering through an initial public offering on a stock exchange. C. Borrowing from a depository institution under a revolving line of credit. D. Selling commodity futures through a clearinghouse. Don't overthink it. Which one feels right? The correct answer is B. A public equity offering through an initial public offering on a stock exchange. B is correct because a public equity offering, often through an initial public offering, sells shares to the broad market on an exchange and gives access to substantial capital in exchange for accepting strict regulation and public scrutiny. The startup's preferences match this path. A is wrong because treasury bonds are issued only by the US federal government, not by private corporations seeking equity capital. C is wrong because a revolving line of credit is short-term debt from a bank, not an equity raise that involves selling ownership stakes. D is wrong because selling commodity futures is a derivative transaction, not a method for raising equity capital for a robotics company. When a company sells shares to the general public for the first time, it's conducting a public equity offering, most commonly called an IPO. This marks one of the most consequential transitions in a company's financial life, moving from privately held to publicly traded. Private investors like venture capital and private equity firms can fund early growth, but their capital pools have limits. A successful IPO can raise hundreds of millions or even billions in a single transaction, funding major expansion, paying off existing investors, and creating a tradable currency for acquisitions and compensation. Mechanically, the company hires an investment bank to underwrite the offering. The bank helps file a registration statement with the SEC, prepares a prospectus disclosing financials and risks, and runs a roadshow to gauge institutional investor demand. The offering price is set based on that demand, and on IPO day, shares begin trading on the chosen exchange. A common exam trap is confusing these three. Public equity means selling ownership broadly through a regulated exchange. Private equity sells stakes to a small group with far less regulatory burden. Bond issuance raises debt. Investors become creditors, not owners. The key signal for a public equity offering is strict regulation, public scrutiny, and shares trading on a major exchange. One final distinction: the IPO itself occurs on the primary market, where new securities are issued for the first time. Once those shares trade among investors afterward, that activity moves to the secondary market. Recognizing that the IPO is the bridge between private and public is usually enough to identify the correct answer on an exam. Question 16. A municipal water authority issues a security to fund the construction of a new treatment plant. The investor lends money in exchange for periodic interest payments and the return of principal at maturity. Which security best matches this description? Your options are A. Common stock in the water authority. B. Preferred stock in the water authority. C. A futures contract on water rights. D. A bond, which is a loan made to a company or government in exchange for interest payments. Got a guess? Lock it in. The correct answer is D. A bond, which is a loan made to a company or government in exchange for interest payments. D is correct because a bond is a loan made to a company or government in exchange for periodic interest payments and the return of principal at maturity. A municipal authority issuing debt to fund infrastructure is issuing bonds, specifically municipal bonds. A is wrong because common stock represents ownership in a company and is not issued by a public water authority to fund construction. B is wrong because preferred stock is an equity security, not a debt instrument, and would not be the mechanism for a municipal infrastructure loan. C is wrong because a futures contract is a derivative based on the future price of an asset, not a debt instrument used to fund a treatment plant. A bond is a debt instrument. When an investor buys a bond, they are lending money to an issuer, not buying ownership in it. In return, the issuer makes periodic interest payments and returns the original principal at maturity. Every bond is defined by three economic terms: the face value, which is the principal repaid at the end, the coupon rate, which determines the annual interest payments, and the maturity date, when the face value is returned and the bond is retired. Picture a $1,000 bond with a 5% coupon and a 10-year maturity. The investor receives $50 every year for 10 years, then gets the full $1,000 back. The issuer, whether a corporation, municipality, or the federal government, is contractually obligated to make every one of those payments. The critical distinction is that bonds are debt and stocks are equity. Bondholders are creditors with contractual rights to interest and principal. Shareholders are owners with no guaranteed payment at sole date, only a residual claim on whatever remains after all obligations are met. Whenever a scenario describes an investor lending money in exchange for periodic interest and the eventual return of principal, that instrument is a bond, regardless of whether the issuer is a corporation, a city, or the federal government. Question 17. A pension fund manager is choosing between three bond categories for the safest portion of the portfolio. The choices are bonds issued by Fortune 500 companies, bonds issued by city governments, and bonds issued by the federal government. Which combination best matches their risk levels? Your options are Treasury bonds are the safest, municipal bonds offer tax advantages, and corporate bonds carry the highest risk and return among the three. B. Corporate bonds are the safest because companies cannot default. C. Municipal bonds are the riskiest because cities have no taxing authority. D. All three categories carry identical risk and the same expected return. Which one is it? Pause the video if you need more time. The correct answer is A. Treasury bonds are the safest. Municipal bonds offer tax advantages, and corporate bonds carry the highest risk and return among the three. A is correct because Treasury bonds are backed by the US government and are considered the safest. Municipal bonds carry tax advantages because their interest is often tax-free, and corporate bonds typically carry higher risk and higher return than the other two. This ordering matches the standard risk ranking taught in business finance. B is wrong because corporate bonds carry the highest default risk among the three categories. Companies can and do default, especially below investment grade. C is wrong because cities do have taxing authority, which is part of what supports municipal bond payments. Municipal bonds are generally less risky than corporate bonds. D is wrong because the three categories differ meaningfully in risk and yield, and bond pricing reflects that difference. The bond market is organized around three fundamental issuer categories, and understanding them unlocks how risk, yield, and taxes all connect. Each category reflects a different borrower with a different ability to repay. Treasury bonds are issued by the federal government, municipal bonds by state and local governments, and corporate bonds by companies. The issuer determines the bond's fundamental character. Default risk rises as you move from treasury to municipal to corporate bonds. The federal government can tax nationwide and create dollars. State and local governments rely on regional revenues, and companies depend entirely on their own cash flow. Tax treatment is just as distinctive as risk. Treasury interest escapes state and local tax. Municipal interest is exempt from federal tax and often from state tax for in-state residents, making it especially valuable in high tax brackets. Corporate interest is fully taxable at every level. When a question asks you to rank bonds by safety or tax treatment, apply this ordering. Treasuries anchor safety. Municipals offer tax efficiency. and corporates deliver higher yields in exchange for higher credit risk. Question 18. An investor reviews the credit ratings on 3 bonds. The first is rated AA, the second is rated BBB+, and the third is rated BB. Which interpretation correctly orders the bonds from safest to riskiest? Your options are AAA is junk, BBB+ is investment grade, BB is safest. B. All 3 are investment grade with identical default odds. C. A is the safest with the lowest expected return. BBB+ is still investment grade, and BB falls into junk bond territory with higher risk and higher potential return. D. The ratings refer to the company's stock price, not default risk. Take a second. Which answer would you pick? The correct answer is C. AA is the safest with the lowest expected return. BBB+ is still investment grade, and BB falls into junk bond territory with higher risk and higher potential return. C is correct because AA is the highest rating and indicates the lowest default risk and lowest expected return. BBB+ is still investment grade, and BB and lower are classified as junk bonds with higher risk and higher potential reward. A is wrong because the ordering is inverted. LA is the safest, not junk, and BB is below investment grade rather than safest. B is wrong because investment grade status ends below BBB. BB is junk, so the 3 are not identical in risk. D is wrong because bond credit ratings measure default risk on the bond's interest and principal payments, not the issuer's stock price. Bond ratings are letter grades published by agencies like Standard & Poor's, Moody's, and Fitch to summarize an issuer's ability to make timely interest and principal payments. They exist because most investors cannot perform deep credit analysis on every bond they consider. So agencies do it and distill the result into a single letter. The scale runs from A at the top, the safest, highest credit quality, down through AA, and BBB, all of which are investment grade. Below BBB begins the non-investment grade, or junk bond, territory BB, B, CCC, CC, CIR, and D, where D represents default. The rating directly drives yield. A higher rated bond is judged less likely to default, so investors accept a lower yield. A lower rated bond carries more default risk, so investors demand a higher yield as compensation. The gap between a treasury and a corporate bond of similar maturity is called the credit spread. Ratings are not permanent. An upgrade signals improved credit quality and typically pushes a bond's price up and its yield down. A downgrade does the opposite. A fallen angel event, when a bond drops from investment grade to junk, is especially disruptive because many institutional mandates require selling below investment grade bonds immediately. The critical exam point is direction. A sits at the top as the safest rating with the lowest expected return, and BB and below fall into junk territory with higher risk and higher yield. Ratings measure credit risk only, not stock performance or any other metric. Question 19. A risk-averse investor wants the safest debt instrument available and is willing to accept a lower yield in exchange for minimal default risk. Which bond category best matches the requirement? Your options are A. High-yield corporate bonds issued by emerging tech startups. B. Treasury bonds which are issued by the United States federal government and carry very low default risk. C. Municipal bonds from a city that has filed for bankruptcy protection. D. Junk bonds rated BB or below. Before I reveal it, which one do you think is right? The correct answer is B. Treasury bonds, which are issued by the United States federal government and carry very low default risk. B is correct because Treasury bonds are issued by the U.S. federal government and are widely considered the safest bonds because they are backed by the government's taxing power. Yields are correspondingly low. A is wrong because high-yield corporate bonds, especially from startups, carry meaningful default risk and high volatility, the opposite of what the investor wants. C is wrong because municipal bonds from a city in bankruptcy carry elevated default risk and would be a poor match for an investor prioritizing safety. D is wrong because junk bonds are below investment grade and carry the highest default risk in the bond market, the opposite of safe. Treasury bonds are debt securities issued by the U.S. federal government, and understanding why they behave the way they do is essential for any fixed income investor. Treasuries carry the lowest credit risk of any U.S. bond because the federal government can tax the entire national economy and expand the money supply if needed. Default is considered a near impossibility under ordinary conditions. The Treasury issues three main types of securities. Bills mature in under a year and earn a return through a purchase discount rather than a coupon. Notes mature between 2 and 10 years, and bonds proper mature between 20 and 30 years, both paying semi-annual coupons. Because treasuries carry minimal credit risk, their yields serve as the benchmark for all other fixed income pricing. A spread reflecting additional credit risk is added on top of the treasury yield to price corporate bonds, mortgage rates, and similar products. The key takeaway is that safety and high yield do not coexist. Treasuries sit at the safe, low-yield end of the risk spectrum. Any scenario describing an investor who wants minimal default risk and accepts lower returns is pointing directly to Treasury bonds. Question 20. An accountant who lives in a state with a high marginal income tax rate wants to invest in bonds that produce interest income exempt from federal income tax and often state income tax as well. Which type of bond best matches that goal? Your options are A. Junk bonds rated BB and below. B. Corporate bonds issued by Fortune 500 firms. C. Treasury bonds issued by the federal government. D. Municipal bonds issued by state or local governments. What's your answer? Commit to one before I continue. The correct answer is D. Municipal bonds issued by state or local governments. D is correct because municipal bonds are issued by state and local governments and typically pay interest that is exempt from federal income tax and often from state income tax for residents of the issuing state. They are designed to be attractive to investors in higher tax brackets. A is wrong because junk bonds pay no special tax benefits and carry high default risk. They do not match the goal of tax-exempt income. B is wrong because corporate bond interest is fully taxable at federal and state levels. Corporate bonds do not provide tax-exempt income. C is wrong because Treasury bond interest is exempt from state income tax, but is fully taxable at the federal level. So Treasuries do not match the dual exemption goal. Municipal bonds are debt securities issued by state and local governments to finance public infrastructure. Understanding what makes them distinctive helps explain why they occupy a unique place in the bond market. The bond structure works like any other. Investors lend capital, receive periodic interest, and get principal back at maturity. What differs is the repayment source. Wat giet Satan in say? General obligation bonds rely on the government's taxing power, while revenue bonds are repaid from the income generated by the finance project itself. The tax treatment across bond categories is not uniform. Corporate bonds are fully taxable at both the federal and state level. Treasury bonds are federally taxable but exempt from state tax. Municipal bonds stand apart with a dual exemption. Interest is typically free from federal tax and often from state tax for in-state residents. Because of this dual exemption, the after-tax yield on a municipal bond frequently beats a higher yielding corporate bond for investors in high tax brackets. The pre-tax yield looks lower, but once taxes are stripped away, the municipal bond often wins, which is exactly why the exemption exists as a policy tool to reduce government borrowing costs. Whenever a scenario highlights an investor in a high tax bracket seeking interest income exempt from federal and often state income tax, the answer is municipal bonds. No other major bond category provides that dual exemption, and that distinction is what makes munis a category of their own. Question 21. A grain processor signs a contract whose price will rise and fall based on the future price of corn rather than on the processor's own intrinsic value. Which category of financial instrument best describes this contract? Your options are A derivative, because its value depends on the price of an underlying asset such as corn. B, common stock in a corn processing company. C, a municipal bond used to fund a corn storage facility. D, a money market mutual fund. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. A derivative, because its value depends on the price of an underlying asset such as corn. A is correct because a derivative is a financial contract whose value depends on another asset such as a stock, commodity, or interest rate. A contract priced based on corn movements is a derivative on corn. B is wrong because common stock represents ownership in a company and does not draw its value from the price of corn directly. The price moves with company earnings and broader market sentiment. C is wrong because a municipal bond is a debt instrument backed by tax revenue, not a contract whose price moves with corn. D is wrong because a money market mutual fund holds short-term debt securities and does not derive its value from a commodity such as corn. A derivative is a financial contract whose value comes entirely from another asset, called the underlying. The contract itself has no intrinsic value on its own. It simply mirrors movements in whatever it references. The underlying can be almost anything: a stock, a bond, a commodity like corn or oil, a foreign currency, an interest rate, or even another derivative. Whatever it is, the derivative's price rises and falls with it. Derivatives come in three main forms. Options give the holder the right, but not the obligation, to buy or sell at a set price. Futures and forwards create a binding obligation to transact at a set price and date. Swaps exchange streams of cash flows, such as a floating interest rate for a fixed one. The same derivative contract can serve opposite purposes. A farmer locking in a corn price through futures is hedging, reducing risk. A trader buying oil futures expecting a price rise is speculating, taking on risk for profit. The contract structure is identical, only the intent differs. The key distinction is this: derivatives are contracts whose value is borrowed from an underlying asset, while stocks and bonds are direct claims on companies or governments. Spotting that dependence on an underlying is usually all you need to identify a derivative. Question 22. A portfolio manager buys a contract that gives her the rights, but not the obligation, to buy 1,000 shares of a software company at a set price within the next 90 days. Which derivative type is this? Your options are A futures contract because the contract has a future expiration. B, a bond because the holder receives interest. C, an options contract because the holder has the right, but not the obligation to execute the trade at a set price. D, a mutual fund share. Which would you go with? Lock it in before the reveal. The correct answer is C, an options contract because the holder has the right, but not the obligation to execute the trade at a set price. C is correct because an options contract gives the holder the right, but not the obligation, to buy or sell at a set price within a specified time. The portfolio manager can let the option expire if the price moves against her, which is the defining feature. A is wrong because a futures contract carries an obligation, not a right, to buy or sell the underlying asset at the set price and date. The right to walk away separates options from futures. B is wrong because a bond is a debt instrument that pays interest, not a contingent right to buy shares at a future date. D is wrong because a mutual fund share represents a proportional interest in a pool of investments, not a right to buy a particular stock at a fixed strike price. Options are a type of derivative that give the holder a right without imposing an obligation. Understanding what makes them unique comes down to a few key features and terms that define how they work. Two features make options distinctive. First, the holder pays a premium upfront to acquire the right embedded in the contract. Second, the holder is never forced to act. They can simply let the contract expire, losing only the premium already paid. Every options contract is defined by four core terms: the underlying asset on which the option is written, the strike price at which the holder can buy or sell, the expiration date marking the last day the right can be exercised, and the premium paid to the writer for granting the right. A call option gives the right to buy the underlying at the strike price, while a put gives the right to sell. Both contrast sharply with a futures contract, which creates a binding obligation to transact. The futures holder cannot walk away from an unfavorable move the way an options holder can. This payoff structure captures the asymmetry options provide. Below the break-even point, the holder's loss is capped at the premium paid. Above it, profits grow as the underlying rises. That limited downside combined with open-ended upside is precisely why investors pay a premium for options rather than simply entering a futures contract. Question 23. A wheat farmer worries that wheat prices will fall before harvest. To lock in a guaranteed sale price, she signs a contract requiring her to deliver 1,000 bushels at $5 per bushel in November. Which derivative is this? Your options are A. An options contract that she can choose to exercise or let expire. B. A municipal bond tied to wheat revenue. C. A mutual fund that invests in agricultural commodities. D. A futures contract because she must buy or sell at a set price on a set date. Don't overthink it. Which one feels right? The correct answer is D. A futures contract because she must buy or sell at a set price on a set date. D is correct because a futures contract creates an obligation to buy or sell an underlying asset at a set price on a set date. The farmer's contract requires delivery in November and is therefore a futures contract. A is wrong because an options contract gives a right but not an obligation. The farmer is locked into the trade and cannot simply let it expire without consequence. B is wrong because a municipal bond is a debt instrument issued by local government and does not lock in commodity prices for an individual farmer. C is wrong because a mutual fund is a pooled investment vehicle and does not lock in a delivery price for the farmer's own crop. A futures contract is a binding agreement to buy or sell an asset at a fixed price on a fixed future date. The key word is obligation. Both the buyer and seller must execute the trade, no matter where the market price ends up. This forced commitment is what separates futures from every other derivative. Every futures contract locks in three things: the underlying asset and quantity, the agreed contract price, and the delivery date. Standardized contracts trade on regulated exchanges, where a clearinghouse sits between buyer and seller, collects margin from both sides, and marks the contract to market daily. The clearinghouse guarantees contract performance by requiring margin deposits from both sides. Each day it marks the contract to market, transferring gains from the losing side to the winning side. In practice, most contracts are closed out with an offsetting trade before delivery, but the ability to demand or make delivery is what keeps futures prices anchored to the underlying. The contrast with options is sharp. An options holder can let the contract expire worthless, losing only the premium paid. A futures holder cannot walk away. Gains and losses are unlimited, and there is no upfront premium capping the downside. Futures suit a user who genuinely wants price certainty and is willing to give up any benefit from a favorable price move. When a scenario describes a party committing to deliver or receive an asset at a set price on a set date with no way out, that is a futures contract. The moment you see forced commitment, not a right, you know you are looking at futures. Question 24. A small investor wants a diversified portfolio that trades throughout the day on a major exchange, with prices that change minute by minute as buyers and sellers transact. Which investment fund best matches that requirement? Your options are A hedge fund priced once per quarter. B, an exchange-traded fund which holds a diversified portfolio but trades on an exchange like a stock. C, a pension fund that is only available to employees of a specific company. D, a money market deposit account. Got a guess? Lock it in. The correct answer is B, an exchange-traded fund which holds a diversified portfolio but trades on an exchange like a stock. B is correct because an exchange-traded fund holds a diversified portfolio similar to a mutual fund, but trades on a stock exchange with intraday pricing that moves as buyers and sellers transact. This matches the investor's preference for live pricing and diversification. A is wrong because hedge funds are typically open to wealthy investors and do not trade throughout the day on a public exchange like an ETF. C is wrong because a pension fund is a retirement vehicle restricted to plan participants and does not function as a tradable instrument for outside investors. D is wrong because a money market deposit account holds cash equivalents at a bank and does not provide intraday tradable diversification across stocks. An exchange-traded fund, or ETF, is a pooled investment vehicle that holds a diversified portfolio of assets and trades on a stock exchange just like a single stock. Understanding what makes ETFs unique comes down to how they combine two features that previously existed separately. Traditional mutual funds offer diversification but price only once per day at market close. Stocks trade continuously but represent a single company. ETFs solve this by listing a diversified fund's shares on an exchange where they trade all day long. The price of an ETF stays close to its underlying portfolio value through a creation and redemption process. Authorized participants, large institutional market makers, can swap the underlying basket of securities for ETF shares, or vice versa. This arbitrage mechanism prevents the ETF's market price from drifting far from its net asset value. ETFs carry 4 key structural advantages: low management fees compared to traditional mutual funds, tax efficiency from the creation and redemption process, transparency through daily holdings disclosure, and intraday tradability. Together, these features have driven enormous growth across virtually every asset class over the past 3 decades. When an exam scenario describes a small investor wanting diversification with prices that change throughout the day, that is an ETF. Mutual funds price once daily at close. ETFs trade continuously on an exchange. That hybrid character is the defining distinction. Question 25. A wealthy investor is interested in an investment fund that uses aggressive strategies, accepts only accredited investors, charges higher fees, and is allowed to take on more risk than a typical mutual fund. Which fund type best matches? Your options are A, a hedge fund, which is restricted to wealthy or accredited investors and uses high risk, high reward strategies. B, an exchange-traded fund available to any retail investor. C, a municipal bond fund that holds tax-exempt securities. D, a pension fund operated by a public school district. Which one is it? Pause the video if you need more time. The correct answer is A, a hedge fund, which is restricted to wealthy or accredited investors and uses high risk, high reward strategies. A is correct because hedge funds are restricted to wealthy or accredited investors and pursue aggressive strategies with higher fees and broader risk than regulated mutual funds. The investor's profile matches a hedge fund. B is wrong because an exchange-traded fund is open to any retail investor and follows regulated investment rules, which is the opposite of the access restriction described. C is wrong because a municipal bond fund holds tax-exempt government debt and is not the aggressive, high-risk strategy described. D is wrong because a pension fund manages retirement contributions for plan participants and follows strict fiduciary rules that exclude aggressive hedge fund tactics. Hedge funds are pooled investment vehicles that use aggressive strategies to pursue returns uncorrelated with the broader market. Unlike mutual funds or ETFs, they aren't open to everyone, and that exclusivity shapes everything about how they operate. 3 features define the category. First, access is restricted to accredited investors who meet income or net worth thresholds. Second, strategy is flexible. Hedge funds can use leverage, short selling, and derivatives that mutual funds cannot. Third, fees are high, typically following the 2 and 20 model. The fund is organized as a limited partnership. The general partner runs the fund and collects 2% of assets under management each year, plus 20% of profits above a benchmark. Limited partners are the investors who supply the capital. Strategies vary widely. Long-short equity funds buy rising stocks and short falling ones. Global macro funds bet on currencies, rates, and commodities. Event-driven funds trade around mergers and bankruptcies. Quantitative funds rely on mathematical models to find opportunities. When a question describes a fund open only to accredited investors, using aggressive strategies, and charging higher fees, that combination points to a hedge fund, not a mutual fund, ETF, or pension fund. Question 26. A biotechnology company sells shares to the public for the first time through an initial public offering. Which type of financial market hosts this transaction? Your options are A. The secondary market, where existing shares change hands between investors. B. A dealer market, where dealers buy and sell from their own inventory. C. The private market, where venture capitalists fund early-stage companies. D. The primary market, where new securities are issued for the first time. Take a second. Which answer would you pick? The correct answer is D. The primary market, where new securities are issued for the first time. D is correct because the primary market is where new securities, including shares in an initial public offering, are issued for the first time. The issuing company receives the proceeds directly from this transaction. A is wrong because the secondary market is where investors trade existing shares after the initial issuance. Day-to-day stock trading on the NASDAQ or NYSE occurs in the secondary market. B is wrong because a dealer market is a structural feature of how trades are matched, not the distinction between new and existing securities. Both new and existing trades can be dealer-based. C is wrong because a private market handles securities sold privately to a limited set of investors, but an initial public offering specifically opens the company to public investors on an exchange. The primary market is where new securities are born. It's the mechanism that connects issuers who need capital with investors willing to provide it, and understanding it is foundational to all of capital markets. Every primary market transaction involves 3 key parties. An underwriter, usually an investment bank, prices and distributes the new securities. A regulator like the SEC reviews the deal, and a prospectus gives investors the material facts they need to decide. In the primary market, cash flows directly to the issuer in exchange for newly created securities. Once those securities exist, they trade on the secondary market, but those subsequent trades send cash between investors, not back to the issuing company. The easiest way to classify any transaction is to ask where the proceeds go. If cash flows to the issuer, it's a primary market event. Securities are being created. If cash flows to another investor, it's secondary. The security itself may be identical. What changes is whether it's new or already existed. Primary market transactions create new securities and fund issuers directly. Secondary market transactions simply transfer existing securities between investors. Keep that contrast clear and you'll never confuse the two. Question 29. A late-stage software firm has not yet sold shares on a public exchange. Instead, it raises capital from a small group of venture capital firms and private investors. With less regulation and limited public disclosure, which market category best matches this scenario? Your options are A. The auction market, because buyers and sellers meet directly. B. The private market, because securities are sold privately to a limited set of investors with lighter regulation. C. The treasury market, because the United States government auctions debt securities here. D. The dealer market, because brokers buy and sell from their own inventory. Before I reveal it, which one do you think is right? The correct answer is B. The private market, because securities are sold privately to a limited set of investors with lighter regulation. B is correct because the private market is where securities are sold privately to a limited set of investors with lighter regulation than the public market. Venture capital and private equity transactions belong here. A is wrong because an auction market is a structural feature of how prices are set when buyers and sellers meet directly. It does not describe whether securities are public or private. C is wrong because the treasury market involves United States government debt auctions and is unrelated to a software firm raising private equity capital. D is wrong because a dealer market refers to how trades are matched by dealers, not whether the securities are public or private. Private markets are a segment of capital markets where securities are sold to a limited number of investors rather than to the general public. They exist because not every company is ready or willing to bear the burden of public ownership. Early-stage startups need flexible capital from investors willing to take big bets. Middle-market companies want growth capital without heavy disclosure. Established firms sometimes go private to escape quarterly earnings pressure and pursue long-term strategy. The defining difference is access and regulation, not trading mechanics. Private securities are exempt from full registration requirements, sold only to accredited investors or qualified institutional buyers, and cannot be freely resold due to holding period restrictions. Venture capital firms back early-stage companies expecting a few big winners to offset many failures. Private equity firms buy mature companies, improve operations, then exit within 5 to 7 years. Pension funds, endowments, and family offices are the typical limited partners in these funds. Remember, private and public markets are defined by who can invest and how heavily regulated the transaction is, not by how trades are matched. A small investor base with lighter regulation points to the private market every time. Question 28. An investor places an order on the New York Stock Exchange, where buyers and sellers meet directly and their bids set the transaction price. Which type of market structure does this describe? Your options are A. An auction market, where buyers and sellers meet directly and their bids set the price. B. A dealer market, where dealers hold inventory and quote prices themselves. C. A private market for late-stage venture capital. D. The treasury market for federal government debt. What's your answer? Commit to one before I continue. The correct answer is A. an auction market where buyers and sellers meet directly and their bids set the price. A is correct because an auction market is one where buyers and sellers meet directly and competing bids set the transaction price. The NYSE is the classic example of an auction market. B is wrong because a dealer market relies on dealers who hold inventory and quote bid and ask prices. NASDAQ is the typical example of a dealer market, not the NYSE. C is wrong because private markets host venture capital deals and are not where individual investors place public trades. The NYSE is a public exchange. D is wrong because the Treasury market involves government debt auctions and is not the venue for stock trades on the NYSE. When markets execute trades, the mechanism matters. An auction market is one where buyers and sellers interact directly, posting bids and offers that compete until they match. Understanding how this differs from a dealer market is essential for the exam. In an auction market, all outstanding bids and offers are collected in a central order book. The best bid and best offers sit at the top, visible to everyone. When a buyer meets the offered price or a seller accepts the bid, a trade executes and is reported to the consolidated tape. 3 features define the auction market structure: a central order book listing all bids and offers, full price transparency so anyone can see the best prices, and direct matching between buyers and sellers without a dealer intermediating. The auction market, typified by the NYSE, matches investors directly through an order book. The dealer market, typified by NASDAQ, routes trades through dealers who hold inventory and quote their own bid and offer prices, earning the spread as compensation for providing liquidity. Remember, auction markets are defined by how orders match, not by who has access. If a scenario describes investors placing orders where competing bids set the price, that is an auction market, not a private market, and not a dealer market. Question 29. A consumer opens a checking account at a community bank, which uses her deposits to fund loans to other customers. Which type of financial institution is this? Your options are A. An investment institution because it manages investments. B. A hedge fund because it pools investor money. C. A depository institution which accepts deposits and lends money. D. An insurance company because it collects premiums. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. A depository institution which accepts deposits and lends money. C is correct because a depository institution accepts deposits from customers and uses the funds to make loans to other customers. Community banks and credit unions are textbook examples. A is wrong because investment institutions such as investment banks and mutual funds do not primarily operate checking accounts or hold consumer deposits in the same way. B is wrong because hedge funds pool investor money for aggressive strategies and do not accept everyday consumer deposits or run checking accounts. D is wrong because insurance companies collect premiums and provide protection against risk, which is a different business model from accepting deposits and lending them out. Depository institutions are a specific category of financial firm defined by one core business model: accepting deposits and making loans. Understanding what makes them distinct is essential for navigating the broader financial system. A depository institution does 2 things. It accepts deposits through checking accounts, savings accounts, and certificates of deposit, and it makes loans to consumers and businesses. The bank earns a spread by paying depositors less interest than it charges borrowers, and that spread covers costs, loan losses, and profit. Commercial banks, savings institutions, and credit unions are all depository institutions. Investment banks, insurance companies, and pension funds are not, even though all of these are financial institutions. The deposit and loan model is the defining line. Mechanically, deposits flow in from households and businesses, and those funds are deployed as loans. The gap between the short-term nature of deposits and the longer-term nature of loans is managed through capital, liquidity reserves, and access to the central bank. Depository institutions face heavier regulation than most financial firms for three reasons: their systemic importance, the government deposit insurance that backs them, and the leverage embedded in their model. Capital requirements, liquidity rules, and on-site supervision exists so ordinary customers never need to audit their own bank's financial health. Question 30. A boutique firm advises corporations on raising capital, underwrites new stock issues, and helps companies execute mergers and acquisitions. Which type of financial institution best matches this description? Your options are A depository institution that accepts checking deposits. B, an investment institution such as an investment bank that helps companies raise capital and manage money. C, an insurance company that collects premiums. D, a pension fund managing retirement savings. Which would you go with? Lock it in before the reveal. The correct answer is B, an investment institution such as an investment bank that helps companies raise capital and manage money. B is correct because investment institutions, including investment banks, help companies raise capital, underwrite stock and bond issues, and advise on mergers and acquisitions. The boutique firm described fits this category. A is wrong because a depository institution focuses on deposits and consumer or commercial lending, not on underwriting and advisory work for corporate clients. C is wrong because an insurance company's core business is risk pooling through premiums and claim payouts, not corporate capital raising or M&A advisory. D is wrong because a pension fund manages retirement savings for plan participants and is not an advisory firm for corporate issuances. Investment institutions are financial firms whose core business is helping companies raise capital, advising on corporate transactions, and managing investment assets. Unlike banks that take deposits or insurers that collect premiums, these firms specialize in capital markets activity. Investment banks offer 4 core service lines. Underwriting helps companies issue securities. Advisory guides major corporate transactions. Sales and trading desks make markets for institutional clients. Research teams publish analysis that supports both businesses. Mechanically, underwriting works like this. The investment bank buys newly issued securities directly from the company and resells them to investors. The bank earns a fee, typically a percentage of the capital raised, rather than earning an interest spread like a deposit-taking institution would. The key distinction is core business. Investment institutions underwrite securities and advise on transactions. Depository institutions accept deposits and make loans. If a scenario describes either of the first two activities, you are looking at an investment institution. When identifying institution type, ignore the fact that all these firms deal with money. Focus on the core business. Capital markets activity means investment institution. Deposits and loans mean depository institution. That single distinction is usually enough. Question 31. A retail company reports current assets of $2.4 million and current liabilities of $1.2 million. Which liquidity ratio captures this comparison, and what does the result indicate? Your options are A, the debt-to-equity ratio of 0.5, signaling moderate leverage. B, the return on assets of 2.0, signaling strong profitability. C, the total asset turnover of 0.5, signaling efficient asset use. D, the current ratio of 2.0, signaling strong short-term liquidity. Don't overthink it. Which one feels right? The correct answer is D, the current ratio of 2.0, signaling strong short-term liquidity. D is correct because the current ratio is current assets divided by current liabilities. A result of 2.0 means the firm has $2 of current assets for every dollar of current liabilities, which signals strong short-term liquidity. A is wrong because debt to equity compares total debt to equity, not current assets to current liabilities. The formula and meaning differ from the current ratio. B is wrong because return on assets is net income divided by total assets and measures profitability, not liquidity. The numerator is wrong for the data given. C is wrong because total asset turnover is revenue divided by total assets and measures efficiency, not liquidity. It does not use current assets or current liabilities. The current ratio is the most fundamental liquidity measure in business finance. It gives any reader of a balance sheet a fast, reliable signal about whether a company can meet its short-term obligations without digging into a full working capital analysis. The numerator captures everything expected to convert to cash within 12 months. The denominator captures every obligation due within 12 months. Dividing the first by the second yields a single number. Above 1 is healthy, below 1 is a red flag. Picture a retailer with 2.4 million in current assets and 1.2 million in current liabilities. Dividing those two figures gives a current ratio of 2.0. Waxus en Wigadipuiti $2 of current assets backing every dollar of short-term debt. That is a comfortable liquidity position for most industries. Interpretation always depends on context. A ratio between 1.5 and 3 is typically viewed as healthy. Below 1 signals that liabilities outstrip available resources. Above 3 may mean the firm is sitting on idle inventory or excess cash that could be deployed more productively elsewhere. The current ratio is the broadest of 3-layered liquidity measures. The quick ratio strips out inventory, and the cash ratio narrows further to only the most liquid assets. Each level tests how much the firm can rely on what remains, giving analysts a progressively stricter view of short-term solvency. Question 32. A wholesale distributor holds significant inventory that is slow to convert into cash. Management wants a stricter liquidity measure that strips out inventory to focus on assets that can be converted to cash more quickly. Which ratio does this best describe? Your options are A. The quick ratio, which equals current assets minus inventory divided by current liabilities. B. The current ratio, which includes inventory and current assets. C. The debt to assets ratio, which compares total debt to total assets. D. The return on equity ratio, which compares net income to equity. Got a guess? Lock it in. The correct answer is A. The quick ratio, which equals current assets minus inventory divided by current liabilities. A is correct because the quick ratio subtracts inventory from current assets before dividing by current liabilities. It provides a stricter view of liquidity by excluding the slowest moving current asset. B is wrong because the current ratio includes inventory in current assets, which makes it less strict than the quick ratio. The wholesaler wants the inventory removed. C is wrong because the debt to assets ratio is a leverage measure that compares debt to total assets and does not focus on liquid current assets. D is wrong because return on equity measures profitability per dollar of equity invested and does not measure short-term liquidity. The quick ratio, also called the asset test, is a stricter measure of short-term liquidity than the current ratio. It focuses only on assets that can be converted to cash within days, deliberately leaving inventory out of the picture. The numerator keeps only the most liquid current assets: cash, marketable securities, and accounts receivable. Inventory and prepaid expenses are stripped out because they cannot reliably be turned into cash on short notice. Consider a distributor with a current ratio of 2, but a quick ratio of 1. Once inventory is removed, the cushion shrinks dramatically. That gap reveals how much the headline number depends on merchandise that may not move quickly under stress. The quick ratio sits between the current ratio and the cash ratio in strictness. The current ratio is broadest, including inventory. The quick ratio excludes inventory but keeps receivables. The cash ratio is strictest, using only cash and equivalents. A quick ratio at or above 1 signals the firm can meet current obligations using only its most liquid assets. Below 1, the firm depends on selling inventory, nabahas, a risk that worsens exactly when economic conditions make inventory hardest to move. Question 33. A startup founder wants the most conservative possible measure of short-term liquidity, one that uses only cash and excludes both inventory and accounts receivable. Which ratio best matches? Your options are A. The current ratio, which uses all current assets. B. The quick ratio, which excludes inventory but includes receivables. C. The cash ratio, which uses only cash divided by current liabilities. D. The fixed asset turnover ratio. Which one is it? Pause the video if you need more time. The correct answer is C. The cash ratio, which uses only cash divided by current liabilities. C is correct because the cash ratio is cash divided by current liabilities and is the most conservative liquidity measure because it excludes both inventory and receivables. The founder's preference matches this ratio. A is wrong because the current ratio uses all current assets, including inventory and receivables, which is less conservative than what the founder wants. B is wrong because the quick ratio excludes inventory but still includes accounts receivable, which means it is more lenient than the cash ratio. D is wrong because fixed asset turnover compares revenue to fixed assets and is an efficiency measure, not a liquidity measure. The cash ratio is the most conservative liquidity measure available, testing whether a firm could pay every current obligation using only the cash it holds right now. Unlike broader ratios, it strips away receivables, inventory, and prepaid expenses entirely. Mechanically, the numerator includes cash, demand deposits, and short-term treasury bills. The denominator is current liabilities due within 12 months, the same denominator used in the current and quick ratios. The cash ratio is the strictest of the 3 standard liquidity measures. The quick ratio adds receivables to the numerator, and the current ratio adds inventory and prepaid expenses, making it the broadest and least conservative of the 3. Most healthy firms carry a cash ratio well below 1 because they rely on receivables collections and inventory sales to meet obligations as they come due. A ratio near 1 may suggest excess idle cash, while a ratio near 0 may indicate the firm has little buffer against disruption. When a scenario calls for the most conservative possible liquidity, read SOM, excluding both inventory and receivables, the cash ratio is the answer. Knowing where each measure sits on the strictness spectrum is the key to choosing correctly on exam day. Question 34. A retailer's current ratio has fallen from 1.8 to 0.9 over 2 years. Which interpretation best describes what is happening, and what action would address it? Your options are A. The retailer is over-investing in inventory and management should expand inventory further. B. The retailer's short-term liquidity has weakened and management should investigate receivables and inventory and consider speeding up collections through customer incentives. C. The retailer's profitability has increased and managers should pay larger dividends. D. The retailer's debt-to-equity ratio is rising and managers should issue more equity. Take a second. Which answer would you pick? The correct answer is B. The retailer's short-term liquidity has weakened, and management should investigate receivables and inventory and consider speeding up collections through customer incentives. B is correct because a current ratio falling below 1 indicates current liabilities exceed current assets, which signals weakening short-term liquidity. Investigating receivables and inventory and offering collection incentives such as discounts for early payment are standard responses. A is wrong because continuing to expand inventory would further tie up current assets in slow-moving stock and worsen the liquidity problem rather than fix it. C is wrong because a change in the current ratio does not directly indicate profitability changes. Profitability is measured by ratios such as profit margin and return on assets. D is wrong because debt to equity addresses capital structure rather than current asset versus current liability composition. Issuing equity may help long-term solvency but does not address the immediate working capital squeeze. When a company's current ratio declines over time, it signals mounting pressure on short-term liquidity. Understanding what drives that decline and how to respond is the core skill tested here. The decline can stem from 3 distinct sources: liabilities outpacing assets, customers taking longer to pay, or unsold inventory accumulating. Each pattern points to a different underlying problem and calls for a targeted management response. Visually, think of receivables and inventory as assets that are technically on the books but not yet cash. When they swell while liabilities keep growing, the buffer between what you own and what you owe shrinks, and the current ratio falls. The standard fixes target cash flow directly. Offering a 210 net 30 discount accelerates collections by rewarding early payment. Just-in-time delivery and tighter demand forecasting reduce cash tied up in stock. Both levers can move the current ratio back toward a healthier range quickly. Remember, the current ratio measures short-term liquidity only. A falling ratio calls for working capital fixes, faster collections, leaner inventory, not equity issuance or debt restructuring. When the ratio drops below 1, the urgency is real and lenders are watching. Question 35. A wholesaler wants to track how quickly customer invoices turn into cash, so the firm can spot slowdowns in collections and improve working capital. Which ratio best supports this goal? Your options are A. The fixed asset turnover ratio, B. The total asset turnover ratio, C. The debt to assets ratio, D. The accounts receivable turnover ratio. Before I reveal it, which one do you think is right? The correct answer is D, the accounts receivable turnover ratio. D is correct because accounts receivable turnover measures how quickly customer invoices are collected and is the most direct ratio for tracking collection speed. A higher turnover indicates faster collections, which improves working capital. A is wrong because fixed asset turnover compares revenue to fixed assets and measures how efficiently equipment and buildings generate sales, not how quickly invoices are collected. B is wrong because total asset turnover measures revenue against all assets and is broader than the receivables question being asked. C is wrong because debt to assets measures leverage, not collection speed on receivables. Accounts receivable turnover is an activity ratio that measures how quickly a firm converts its credit sales into actual cash. Understanding it requires seeing why credit sales create a timing problem in the first place. When a firm sells on credit, it is effectively lending money to its customers. Strong reported revenue can coexist with a cash shortage if collections are slow, because the cash hasn't actually arrived yet. The formula divides net credit sales by average accounts receivable. The result can then be converted into days sales outstanding by dividing 365 by the turnover ratio. A turnover of 12, for example, corresponds to roughly 30 days to collect the average invoice. A high turnover signals strong collection discipline and a healthy working capital cycle. A falling turnover is a warning sign. Customers are paying more slowly than terms require, which ties up cash and can signal collection problems or customer financial stress. The exam trap is confusing receivables turnover with broader measures. Fixed asset turnover compares revenue to equipment and buildings. Total asset turnover covers all assets. Receivables turnover focuses narrowly on how fast credit sales convert to cash. That narrow focus is what makes it the right ratio when the question is about invoice collection speed. Question 36. A manufacturer reports revenue of $1 billion and total assets of $1.8 billion. Which ratio captures this relationship and what does it measure? Your options are the total asset turnover ratio of 0.56, which measures how efficiently the firm uses all its assets to generate revenue. B, the current ratio of 0.56, which measures short-term liquidity. C, the debt-to-equity ratio of 0.56, which measures leverage. D, the return on equity of 0.56, which measures profit per dollar of equity. What's your answer? Commit to one before I continue. The correct answer is A, the total asset turnover ratio of 0.56. which measures how efficiently the firm uses all its assets to generate revenue. A is correct because total asset turnover is revenue divided by total assets and measures how much revenue the company generates per dollar of assets. A ratio of 0.56 means the firm generates about 56 cents of revenue per dollar of assets. B is wrong because the current ratio uses current assets and current liabilities, not total revenue and total assets, so the formula does not match. C is wrong because the debt-to-equity ratio compares debt to equity and does not use revenue in its formula. D is wrong because return on equity uses net income divided by equity, not revenue divided by total assets. Total asset turnover is an efficiency ratio that measures how much revenue a company generates for every dollar of assets it holds. It tells us how productively a firm deploys its entire asset base to drive sales. The formula divides revenue from the income statement by total assets from the balance sheet. A higher result signals efficient use of resources, while a lower result suggests the asset base is not being fully utilized. Analysts often average beginning and ending total assets to account for changes during the period. Interpretation depends heavily on industry. Retailers and grocery chains generate large sales volumes relative to their assets, producing high turnover. Capital-intensive industries like utilities and railroads carry enormous asset bases compared with annual revenue, resulting in low turnover. Comparing the ratio across industries is misleading. Total asset turnover also connects to profitability through the DuPont decomposition, which breaks return on equity into profit margin, asset turnover, and financial leverage. Improving any one of these three drivers raises return on equity, and the ratio analysis reveals which lever matters most for a given firm. The common exam trap is confusing asset turnover with leverage or profitability ratios because all three use balance sheet denominators. The clue is always the numerator. Revenue points to an efficiency ratio, net income points to a profitability ratio like return on assets, and liabilities or interest point to leverage ratios. Question 37. A logistics company has invested heavily in trucks, warehouses, and loading equipment. The CFO wants to measure how efficiently this fixed asset base generates revenue. Which ratio is most relevant? Your options are A, the current ratio, which compares current assets and liabilities. B, the debt-to-equity ratio, which compares debt and equity. C, the fixed asset turnover ratio, which compares revenue to fixed assets. D, the profit margin, which compares net income to revenue. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C, the fixed asset turnover ratio, which compares revenue to fixed assets. C is correct because the fixed asset turnover ratio is revenue divided by fixed assets and measures how efficiently long-lived assets such as trucks and warehouses generate revenue. The CFO's question maps directly to this ratio. A is wrong because the current ratio measures short-term liquidity using current assets and liabilities, not fixed asset efficiency. B is wrong because debt to equity measures leverage and does not measure asset efficiency. D is wrong because profit margin measures earnings per dollar of revenue and does not measure fixed asset efficiency. Fixed asset turnover is an efficiency ratio that measures how much revenue a company generates for every dollar invested in long-lived assets like property, plant, and equipment. Understanding how it works, and when to use it is essential for analyzing capital-intensive businesses. The formula divides revenue from the income statement by net fixed assets from the balance sheet. Net fixed assets subtract accumulated depreciation from the original cost of property, plant, and equipment. A higher result means the asset base is working harder. A lower result may reflect underutilization or a recent expansion whose sales have not yet caught up. Consider a logistics company with $250 million in revenue and $300 million in net fixed assets. Its fixed asset turnover is roughly 0.83, meaning each dollar of trucks, warehouses, and equipment generates about 83 cents of revenue. The ratio surfaces whether that heavy infrastructure is being put to work efficiently. The key distinction to remember is scope. Fixed asset turnover isolates long-lived assets, factories, equipment, property, and asks how productive they are at generating revenue. Total asset turnover broadens the lens to every asset on the balance sheet, including working capital and intangibles. Choose based on whether the scenario focuses on fixed assets specifically or the full asset base. When the scenario mentions equipment, factories, or property and asks about efficiency, fixed asset turnover is the right tool. If the scenario covers the entire asset base, reach for total asset turnover instead. Matching the ratio to the asset scope is the key habit to build. Question 38. A growing tech firm has total liabilities of $300 million and total equity of $450 million. Which leverage ratio captures this relationship and what does it indicate? Your options are A. The current ratio of 0.66, which measures liquidity. B. The debt to equity ratio of 0.66, indicating moderate use of debt relative to equity financing. C. The return on assets ratio of 0.66, measuring profitability. D. The total asset turnover ratio of 0.66, measuring efficiency. Which would you go with? Lock it in before the reveal. The correct answer is B. The debt to equity ratio of 0.66, indicating moderate use of debt relative to equity financing. B is correct because debt to equity is total liabilities divided by total equity and shows how much debt is used relative to equity to finance the firm. A ratio of 0.66 means about 66 cents of debt for every dollar of equity, signaling moderate leverage. A is wrong because the current ratio uses current items, not total liabilities and equity. The formula and interpretation differ. C is wrong because return on assets uses net income and total assets, not liabilities and equity. D is wrong because total asset turnover uses revenue and assets, not liabilities and equity. The debt to equity ratio is a core leverage measure in corporate finance. It tells us how much of a firm's capital structure is financed by debt compared to equity. And understanding it deeply means understanding why those two financing sources behave so differently. Both inputs come directly from the balance sheet. Total liabilities include short-term and long-term debt plus obligations like accounts payable. Total equity includes common stock and retained earnings. Dividing liabilities by equity gives you one clean number representing the firm's leverage. Interpreting the number is straightforward. A ratio of 1 means debt and equity are equal. A ratio of 2 means the firm carries twice as much debt as equity. A ratio of 0.5 means debt is only half the size of equity. A conservatively leveraged firm. The ratio exists because debt and equity carry fundamentally different costs and risks. Debt is cheaper and generates a tax shield on interest payments, but it creates fixed obligations the firm must meet. Equity avoids default risk but is more expensive and offers no tax benefit. The debt-to-equity ratio captures exactly where a firm sits between these two forces. The exam key is recognizing which two balance sheet items are being compared. If you see total liabilities over total equity, that is the debt-to-equity ratio, a leverage measure. Don't confuse it with debt to assets or return on equity. The formula and its balance sheet home are all you need. Question 39. A company reports earnings before interest and taxes of $15 million and interest expense of $2 million. Which leverage-related ratio captures the firm's ability to cover its interest payments? Your options are A. The current ratio, which measures short-term liquidity. B. The cash ratio, which measures conservative liquidity. C. The debt-to-equity ratio, which compares debt and equity. D. The times interest earned ratio of 7.5, indicating EBIT covers interest about 7.5 times. Don't overthink it. Which one feels right? The correct answer is D. The times interest earned ratio of 7.5, indicating EBIT covers interest about 7.5 times. D is correct because the times interest earned ratio is EBIT divided by interest expense and measures how many times the firm's operating earnings cover its interest payments. A ratio of 7.5 is generally strong coverage. A is wrong because the current ratio measures short-term liquidity using current assets and liabilities, not interest coverage from operating earnings. B is wrong because the cash ratio uses cash and current liabilities and does not measure interest coverage. C is wrong because debt to equity measures capital structure but does not directly compare earnings to interest expense. Times interest earned is a leverage ratio that measures how well a firm's operating earnings cover its interest expense. It answers a simple but critical question. How much cushion does the firm have before it can't make its interest payments? The formula divides EBIT by total interest expense. EBIT is used rather than net income because interest is deducted before net income is calculated, and we want to compare operating earnings to interest before that deduction. A firm with 15 million in EBIT and 2 million in interest expense has a ratio of 7.5. Interpretation depends on the absolute level. A ratio above 5 is generally comfortable, providing meaningful cushion. Between 2 and 5 is workable but warrants attention. Below 2 raises serious concerns, and below 1 means the firm cannot cover interest from current operating earnings at all. Times interest earned is often confused with other ratios. Debt to equity measures capital structure proportions. The current ratio measures ability to pay short-term liabilities from current assets. Times interest earned is distinct. It focuses specifically on covering interest from operating earnings, not on liquidity or capital structure. Remember, if a question gives you EBIT and interest expense, it is asking about times interest earned, not the current ratio or debt to equity. Each ratio answers a different question, and choosing the right one starts with identifying which inputs are given. Question 40. A manufacturer with very low debt to equity is debating whether to take on additional debt to fund expansion. What is the key trade-off the CFO must consider? Your options are all. Cheap debt with tax benefits can fuel growth, but more debt also raises bankruptcy risk. So the goal is an optimal mix that balances growth and risk. B. More debt always lowers risk and is always preferred. C. Equity financing carries higher tax benefits than debt financing. D. The firm should issue only convertible preferred stock to avoid any leverage decision. Got a guess? Lock it in. The correct answer is A. Cheap debt with tax benefits can fuel growth, but more debt also raises bankruptcy risk. So the goal is an optimal mix that balances growth and risk. A is correct because debt is typically cheaper than equity and offers tax advantages on interest, which can fuel growth, but higher debt levels increase bankruptcy risk. The optimal capital structure balances these benefits and risks. B is wrong because more debt raises financial risk, not lowers it. Excessive leverage is what causes bankruptcy under stress. C is wrong because interest on debt is tax deductible, while dividends paid to equity holders are not. Debt typically has the tax advantage, not equity. D is wrong because convertible preferred stock is one specific instrument but does not eliminate the underlying capital structure decision. Capital structure is the mix of debt and equity a firm uses to finance itself. The central challenge is finding the combination that minimizes the cost of capital without exposing the firm to unacceptable financial risk. Debt costs less than equity because lenders have a contractual claim on interest and principal and a senior position in liquidation. The tax deductibility of interest reduces the after-tax cost of debt even further. Equity holders bearing residual risk demand a higher return as compensation. As leverage rises from zero, the tax shield initially pushes the weighted average cost of capital down. But beyond the optimal point, lenders demand higher rates for default risk. Equity holders demand more for their riskier residual claim, and WACC reverses course and climbs. The optimal leverage ratio differs across firms based on 4 key factors: cash flow stability, industry risk, growth prospects, and access to capital markets. A utility with predictable regulated revenue can carry far more debt than an early-stage biotech with uncertain approvals. Capital structure is a balancing act, not a permanent formula. Neither all debt nor all equity is optimal. The right mix depends on the firm's circumstances, and the goal is always to minimize cost while keeping financial distress at a tolerable level. Question 41. A retail chain reports net income of $180 million and total assets of $1 billion. Which profitability ratio captures the return on each dollar of assets, and what is the result? Your options are A. The debt-to-equity ratio of 0.18. B. The return on assets of 18%, which measures net income per dollar of assets. C. The current ratio of 0.18. D. The total asset turnover of 0.18. Which one is it? Pause the video if you need more time. The correct answer is B. The return on assets of 18%, which measures net income per dollar of assets. B is correct because return on assets is net income divided by total assets. With net income of $180 million and assets of $1 billion, ROE is 18%, meaning the firm earns 18 cents of profit per dollar of assets. A is wrong because debt to equity uses liabilities and equity, not net income and total assets. The formula and meaning differ. C is wrong because the current ratio uses current items only, not full net income and total assets. D is wrong because total asset turnover compares revenue to assets, not net income to assets, so it measures efficiency rather than profitability. Return on assets is a profitability ratio that tells us how much net income a company generates for every dollar of assets it controls. It normalizes profit by the size of the asset base, making comparisons across firms and time periods meaningful. Mechanically, ROA divides net income by total assets. Some analysts substitute operating income to focus on performance before financing decisions. while others average the beginning and ending asset balances to reduce the impact of mid-period changes. Row A draws from two different financial statements. Net income comes from the income statement and total assets come from the balance sheet. Together they produce a single percentage that captures how productively the firm deploys its resources. The classic exam trap is confusing ROA with return on equity. Both use net income as the numerator, but ROA divides by total assets while ROE divides by shareholder equity, because leverage lets a firm control more assets than equity alone. ROE is amplified relative to ROA whenever debt is present. Through DuPont decomposition, ROA equals profit margin multiplied by asset turnover. A firm can improve ROA by earning more income per dollar of revenue, or by generating more revenue per dollar of assets. Identifying which lever is moving is a powerful diagnostic and ratio analysis. Question 42. A consulting firm reports net income of $90 million and shareholder equity of $300 million. Which ratio measures the return generated for each dollar of equity invested in the firm? Your options are A. The cash ratio of 0.3. B. The profit margin of 0.3. C. The total asset turnover of 0.3. D. The return on equity of 30%, which measures net income per dollar of equity. Take a second. Which answer would you pick? The correct answer is D. The return on equity of 30%, which measures net income per dollar of equity. D is correct because return on equity is net income divided by shareholder equity. 90 million divided by 300 million equals 30%, which means the firm earns 30 cents of profit for every dollar of equity invested. E is wrong because the cash ratio uses cash and current liabilities and does not measure profitability per dollar of equity. B is wrong because profit margin is net income divided by revenue, not by equity, so it answers a different question. C is wrong because total asset turnover compares revenue to total assets and measures efficiency, not return on equity. Return on equity is a profitability ratio that measures how much net income a company generates for every dollar of shareholder equity. Unlike return on assets, it isolates the owner's perspective, showing how productively their contributed capital is being put to work. The formula divides net income by total shareholder equity. For example, a firm with $90 million of net income and $300 million of equity earns a return on equity of 30%. 30 cents of profit for every dollar owners have invested. The key distinction is the denominator. Total assets include funds from both lenders and owners, while shareholder equity reflects only the owner's contribution. Return on equity narrows the lens to the owner's slice of the capital structure. The DuPont decomposition breaks return on equity into three drivers: profit margin, which measures profit per dollar of revenue; asset turnover, which measures revenue per dollar of assets; and the equity multiplier, which captures how much leverage the firm uses. Multiplied together, these three equal return on equity. The fastest way to avoid confusing these ratios is to check the denominator. Equity points to return on equity, total assets to return on assets, and revenue to profit margin. A high ROE driven by leverage signals risk, not necessarily strong operations. Question 43. A software company earns net income of $324 million on revenue of $1 billion. Which ratio captures how many cents of profit the company keeps for each dollar of sales? Your options are the profit margin of 32.4%, meaning the firm keeps about 32 cents per dollar of sales. B. The current ratio of 0.32, which measures liquidity. C. The fixed asset turnover of 0.32. D. The debt to assets ratio of 0.32. Before I reveal it, which one do you think is right? The correct answer is A. The profit margin of 32.4%, meaning the firm keeps about 32 cents per dollar of sales. A is correct because profit margin is net income divided by revenue and shows what share of each sales dollar becomes profit. 324 million on 1 billion of revenue gives a profit margin of 32.4%. B is wrong because the current ratio uses current assets and liabilities, not net income and revenue. It is a liquidity measure, not a profitability measure. C is wrong because fixed asset turnover compares revenue to fixed assets, not net income to revenue. D is wrong because debt to assets compares debt to assets and does not measure profit per dollar of sales. Profit margin is a profitability ratio that answers one essential question. Of every dollar a company earns in revenue, how many cents actually survive as profit after all costs, interest, and taxes are paid? The calculation is straightforward. Net income sits at the bottom of the income statement after every expense is deducted. Revenue sits at the top before any deductions. Dividing them gives you the share of each sales dollar the firm actually keeps. Visually, the income statement flows from revenue at the top, downward through costs, interest, and taxes until net income remains at the bottom. Profit margin simply measures the distance between those two anchors as a percentage. The most common exam trap is confusing profit margin with return on assets or return on equity. The clue is always the denominator. Revenue in the denominator means profit margin. Total assets means return on assets. Equity means return on equity. Always compare profit margins within the same industry. Software firms routinely earn margins above 30% while grocery chains operate in the low single digits. Spot the denominator, identify the ratio, and interpret the number in its industry context. Question 44. An investor sees that a major technology company has a share price of about $228 and earnings per share of about $6.4. Which ratio captures this relationship and what does it indicate? Your options are: A. The current ratio is about 36, indicating strong liquidity. B. The return on assets is about 36%, indicating strong profitability. C. The price to earnings ratio is about 36, meaning investors pay about $36 for every dollar of earnings. D. The debt to equity ratio is about 36, indicating extreme leverage. What's your answer? Commit to one before I continue. The correct answer is C. The price to earnings ratio is about 36, meaning investors pay about $36 for every dollar of earnings. C is correct because the price to earnings ratio is share price divided by earnings per share. 228 divided by 6.4 equals roughly 36, meaning investors pay about $36 for every dollar of annual earnings. A is wrong because the current ratio uses current assets and current liabilities, not stock price and earnings. B is wrong because return on assets uses net income and total assets, not share price and earnings per share. D is wrong because debt to equity uses liabilities and equity, not share price and EPS. A value of 36 would also indicate dangerously high leverage rather than PE. The price to earnings ratio, or PE, is one of the most widely used tools in investment analysis. It connects a company's current share price to its earnings per share, giving investors a standardized way to assess valuation. Dividing share price by earnings per share produces a multiple, the number of dollars investors pay for every dollar of annual earnings. A higher multiple signals optimism about future growth, while a lower multiple reflects caution or greater uncertainty. For example, A technology company trading at $228 with earnings per share of $6.40 has a PE of roughly 36. That means the market pays $36 for each dollar of annual earnings the company generates. Interpretation always requires industry context. High-growth technology firms often carry PE ratios above 30, while mature consumer staples sit between 15 and 20. Cyclical industries trade at lower multiples due to earnings volatility. Comparing PE ratios within an industry, or against a company's own history, is far more meaningful than cross-industry comparisons. The exam shortcut is straightforward. If a scenario gives you share price and earnings per share, you're looking at the PE ratio. Don't confuse it with return on assets, which uses net income and total assets, or debt to equity, which involves liabilities and equity. Question 45. A collector once bought a vintage baseball card with a face value of 5 cents that now trades among collectors for $91. Which financial concept best explains the gap between the original printed value and the current trading price? Your options are A. The current ratio versus the cash ratio. B. The distinction between book value, taken from financial records, and market value, which is what buyers are actually willing to pay. C. The profit margin versus the return on assets. D. The price to earnings ratio versus the dividend yield. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. The distinction between book value, taken from financial records, and market value, which is what buyers are actually willing to pay. B is correct because book value comes from financial records or printed values, while market value is what buyers are actually willing to pay in the market. The 5-cent face value is the book value, while $91 is the market value driven by collector demand. A is wrong because current ratio and cash ratio are both liquidity measures and do not explain the gap between printed face value and trading price. C is wrong because profit margin and return on assets are both profitability measures and do not address the difference between recorded book values and traded market prices. D is wrong because price to earnings and dividend yield are market ratios applied to operating businesses, not to collectibles, and they do not explain the book versus market value distinction itself. Book value and market value both describe what something is worth, but they use completely different frameworks to get there. Understanding the gap between them is one of the most fundamental skills in financial analysis. Book value comes from financial records, what was originally paid, adjusted for depreciation and accounting conventions. Market value is the live price set by current supply, demand, and expectations. The two can be close or dramatically far apart. A classic example, a vintage baseball card printed with a face value of 5 cents now trades among collectors for $91. The face value is the book value, fixed at the time of printing. The $91 is the market value set entirely by current collector demand. The price to book ratio compares market value per share to book value per share. Banks are often analyzed this way because their balance sheet assets are meaningful. Technology firms trade at very high price to book ratios because most of their value lies in intangibles not recorded on the balance sheet. Book value comes from financial records and accounting rules. Market value comes from active trading. The two describe the same asset through different lenses, and the gap between them is one of the most watched signals in all of financial analysis. Question 46. A central bank economist watches a particular indicator that measures the total value of goods and services produced inside a country. A rising value signals economic expansion, while a sustained drop can signal a recession. Which indicator is this? Your options are A. The Consumer Price Index, which measures consumer price changes. B. The unemployment rate, which measures jobless workers. C. The producer price index, which measures producer price changes. D. Gross domestic product, which measures the total value of goods and services produced. Which would you go with? Lock it in before the reveal. The correct answer is D. Gross domestic product, which measures the total value of goods and services produced. D is correct because gross domestic product measures the total value of goods and services produced inside a country. Growth signals expansion and sustained decline can signal recession, which matches the description. A is wrong because the Consumer Price Index measures consumer price changes and is used to track inflation, not total production. B is wrong because the unemployment rate measures the share of the labor force without a job, not the value of all goods and services produced. C is wrong because the Producer Price Index tracks price changes at the wholesale or producer level and forecasts future consumer price moves, not aggregate production. Gross domestic product is the broadest measure of a country's economic output, the total value of all goods and services produced inside a country's borders during a given period. It is the single most watched summary indicator of how an economy is performing. GDP can be calculated three ways that should produce the same number. The expenditure approach sums consumer spending, investment, government spending, and net exports. The income approach sums wages, profits, and rents. The production approach sums value added by all industries. GDP is reported in both nominal and real terms. Nominal GDP rises when output grows, but also when prices rise. Real GDP strips out inflation, holding prices constant at a base year, so it reflects only actual changes in economic activity. Real GDP is the number most economists focus on. A common exam trap is confusing GDP with related indicators. The Consumer Price Index tracks inflation. The unemployment rate measures jobless workers. The Producer Price Index tracks wholesale prices. Only GDP captures the total value of all goods and services produced, making it the broadest macroeconomic measure of all. Remember, rising real GDP signals expansion. 2 consecutive quarters of falling real GDP is the conventional definition of a recession. When a question describes total value of goods and services produced inside a country, that is always GDP. Question 47. A federal agency tracks a basket of consumer goods and services to monitor how prices that households face are changing. A rising value indicates that the cost of living is increasing. Which indicator is this? Your options are A. Gross domestic product, B. The unemployment rate, C. The Consumer Price Index, which measures consumer price changes and is used to track inflation, D. Times interest earned. Don't overthink it. Which one feels right? The correct answer is C. The Consumer Price Index, which measures consumer price changes and is used to track inflation. C is correct because the Consumer Price Index measures changes in the prices of a basket of consumer goods and services and is the primary measure of cost of living inflation. A rising CPI signals rising consumer prices. A is wrong because gross domestic product measures the total value of goods and services produced, not changes in consumer prices. B is wrong because the unemployment rate measures the share of the labor force without a job and does not measure price changes. D is wrong because times interest earned is a corporate leverage ratio, not a macroeconomic price indicator. The Consumer Price Index, or CPI, is the economy's primary thermometer for consumer price inflation. It tracks how much the cost of living is actually changing for everyday households over time. The basket is carefully chosen to reflect typical household spending, categories like food, housing, energy, transportation, and medical care are all weighted according to how much consumers actually spend on them each month. Price stability matters because extreme moves in either direction cause harm. Rapidly rising prices erode purchasing power, while falling prices raise real debt burdens. CPI gives policymakers, businesses, and households the continuous reading they need to make sound decisions. Because so many things are automatically adjusted using CPI, including Social Security payments, federal tax brackets, tips investments, and wages. Changes in the index ripple across the entire economy and federal budget. Remember, the Producer Price Index tracks wholesale prices, GDP measures total output, and the unemployment rate counts jobless workers. Only CPI answers the question of how consumer prices are changing over time. Question 48. A market analyst watches the yield curve closely. Recently, short-term yields have risen above long-term yields, producing an unusual inverted shape. Which interpretation best matches what this typically signals? Your options are: A. An inverted yield curve has historically been a warning sign of a potential recession. B. An inverted yield curve always indicates strong economic expansion. C. An inverted yield curve has no economic meaning and is purely a statistical artifact. D. An inverted yield curve guarantees higher inflation within 90 days. Got a guess? Lock it in! The correct answer is A. An inverted yield curve has historically been a warning sign of a potential recession. A is correct because an inverted yield curve, where short-term yields exceed long-term yields, has historically been a warning sign of a potential recession. Investors interpret it as a signal that markets expect weaker future growth. B is wrong because an inverted curve signals concern about future growth, not strong expansion. The relationship is the opposite. C is wrong because the yield curve carries meaningful economic information. Inversions have preceded most modern U.S. recessions and are widely watched. D is wrong because an inverted curve does not guarantee any specific inflation outcome. It is a leading indicator of growth concerns, not a precise inflation prediction. The yield curve plots interest rates on government bonds across different maturities. Under normal conditions, it slopes upward, meaning longer-term bonds offer higher yields than short-term ones. When it inverts, that relationship flips. The most closely watched inversion is when the 2-year Treasury yield rises above the 10-year Treasury yield. That crossover is the classic signal analysts monitor, and persistent inversion across multiple maturities is considered a stronger warning. The shape of the curve encodes market expectations. An upward slope suggests investors expect rising rates, growth, and inflation. A flat curve reflects uncertainty. An inverted curve signals that investors expect economic weakness and future central bank rate cuts. Inversion matters beyond recession prediction. It compresses bank lending margins, influences investor positioning, and tells policymakers how the market reads their decisions. Historically, most modern U.S. recessions have been preceded by an inverted yield curve, though the signal is not a perfect guarantee. The critical takeaway is directional. An inverted yield curve signals concern about future conditions, not optimism. Any interpretation that treats inversion as positive for growth is incorrect. But as is said, it is a leading indicator of potential recession risk. Question 49. A publicly traded company faces a recurring tension. Senior managers control day-to-day decisions, but may favor projects that boost their personal compensation or expand their power, while shareholders want the firm to maximize long-term value. Which ethical concept best describes this tension? Your options are: A. Corporate social responsibility, which involves balancing profit and social impact. B. The agency problem, the conflict between managers acting in self-interest and shareholders who want long-term value, often addressed through strong governance and performance-based pay. C. Environmental sustainability, which focuses on ecological impact. D. Offshoring concerns, which involve overseas labor practices. Which one is it? Pause the video if you need more time. The correct answer is B. The agency problem, the conflict between managers acting in self-interest and shareholders who want long-term value, often addressed through strong governance and performance-based pay. B is correct because the agency problem describes the conflict between managers who control daily decisions and shareholders who want long-term value. Strong governance structures and performance-based compensation are common remedies. A is wrong because corporate social responsibility involves social and environmental considerations beyond profit, but does not specifically capture the manager versus shareholder tension described. C is wrong because environmental sustainability addresses ecological impact and resource use, not the principal-agent conflict inside the firm. D is wrong because offshoring raises ethical questions about labor practices in foreign countries and does not describe the internal manager-shareholder tension. The agency problem describes a fundamental tension built into how modern corporations are structured. To understand it, we need to look at who owns the firm and who actually runs it. Shareholders are the principals. They own the firm and want it to maximize long-term value. Senior managers are the agents. They control day-to-day decisions but may pursue goals that serve themselves rather than the owners. That gap between the two sets of incentives is the core of the agency problem. The agency problem exists because ownership and control are separated. A founder who both owns and runs a small business has no agency problem. The principal and agent are the same person. But as firms grow and ownership disperses, shareholders must delegate management to professional executives, and that delegation opens the door to misaligned incentives. The standard remedies are governance and compensation design. An independent board oversees management and can remove underperforming executives. Performance-based pay through stock grants, options, or bonuses tied to financial targets aligns manager incentives with shareholder outcomes. The exam trap is confusing the agency problem with related ethics concepts. Corporate social responsibility, environmental sustainability, and offshoring concerns are all distinct. The agency problem is specifically the internal conflict between managers and shareholders, resolved through governance and compensation design. Question 50. A consumer products firm publishes a sustainability report covering environmental impact, social practices, and governance standards alongside its financial results. Which framework best describes what the firm is reporting? Your options are A. The price-to-earnings ratio framework, B. The current ratio and quick ratio framework, C. Environmental, social, and governance factors, often abbreviated as ESG, which support long-term sustainability alongside financial performance. D. Times interest earned and debt to equity. Take a second. Which answer would you pick? The correct answer is C. Environmental, social, and governance factors, often abbreviated as ESG, which support long-term sustainability alongside financial performance. C is correct because ESG stands for environmental, social, and governance factors and represents the framework that supports long-term sustainability alongside financial performance. Sustainability reports typically organize information around these three categories. A is wrong because price to earnings is a single market valuation ratio, not a reporting framework that covers environmental and social topics. B is wrong because current ratio and quick ratio are liquidity measures and do not address environmental or governance reporting. D is wrong because times interest earned and debt to equity are leverage ratios and do not encompass environmental and social reporting. Environmental, social, and governance factors. ESG. Give investors a framework for evaluating long-term sustainability alongside traditional financial performance. Unlike a single ratio, ESG captures risks and opportunities that standard financial analysis can miss. The framework has 3 pillars. Environmental factors cover a firm's impact on climate, natural resources, and pollution. Social factors cover relationships with employees, customers, and communities. Governance factors cover board structure, executive pay, audit quality, and shareholder rights. ESG analysis typically combines quantitative metrics like carbon emissions, employee turnover, and board independence with qualitative judgments, often aggregated by ratings agencies into scores that investors use to compare companies. The key exam distinction is that ESG is a broad framework, not a single financial measure. Price to earnings is a valuation metric. Current and quick ratios measure liquidity. Times interest earned and debt to equity are leverage ratios. Only ESG addresses environmental, social, and governance sustainability together. ESG goes beyond any single number. It surfaces long-term risks and opportunities that traditional ratio analysis cannot capture on its own.
You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.